We got this breaking news from the Bank of Japan that indicated it's going to slightly tweak its cap on its yields for the 10-year. Can you explain why we were seeing global bond yields spiking after that announcement?
Yes. Hi, Contessa. Thanks for having me on the show this morning. I've got to say that what you have seen around the world has been central banks tightening, and the outlier was the Bank of Japan. Now, the process of their beginning to move in with the others really simply means that now it's all the majors are in the process of hiking rates. Ultimately, it's probably a very positive thing because it's the end of free money. Free money raises speculation, high leverage, momentum trading. This could really take us back to a more fundamental point. It's not that leverage will disappear. Interest rates are not that high if we look at it historically. I've been in this business 39 years, so I can remember stocks moving higher with yields a heck of a lot higher than they are today, early in my career. But when we look at it, we think it's actually a positive, but of course, it creates volatility, as we've already seen this morning.
Yeah, we did see even the U.S. Treasury yield spiking 6 points or so on that news. Let me ask you, Jenny, when we're looking at inflation, it's a problem in Japan, it's a problem in Europe, it's a problem globally, and here we still see a Fed that seems intent on tackling it through, and one of my previous guests this morning said, through making sure that unemployment is not so low, that we don't have so many job openings, that the wage inflation factor has something that has to be tackled at this point. Where do we head from here in 2023?
Well, from a market perspective, I agree that it's actually healthier to have higher interest rates. And so we're just in this like really messy, really kind of difficult time to get through, because I look at it like the Fed is just delivering medicine. We've been raging at a party for way too long. The party got out of control, and they're delivering medicine. So we've had the worst of the medicine, and they've said, like, look, we're past 75 basis point hike, 50. Now we've got 25s coming. So we're kind of on the downside of that. So where we stand is I think we're just in this digestion period. And what you know as an investor is that the numbers don't matter as much as knowing what the numbers are going to be. Yeah, give us that 50, fine. Give us a few more 25s. Let us get through this. So where we are is getting closer to understanding where inflation's really going to end up, how long it's going to really last, and at what level. I've seen some really interesting charts that show that strategists all think in an inflationary environment that inflation goes like this, and then it comes right back down and then plateaus. And that's what strategists think. But in past inflationary times, what really happens is inflation spikes up, and then it actually takes a very long time to kind of plateau out and reach a steady state, get back to maybe 2% or 2.5%. So I think we're in this adjustment period of just understanding that and being able to work that into, as portfolio managers, work that into our valuation models. And I really do think that as a money manager, whether you're buying bonds or stocks, having a functional risk-free rate of return is really useful. You can actually run discounted cash flow models and get real numbers again. So even though this is hard, it's not bad for the long run.
John, how are you looking at fixed income heading into 2023 and the opportunities there?
Well, the good news is once we've returned to a period where bond buyers are getting something back in terms of the yield when they buy a bond, and bond issuers have to pay for the privilege of borrowing money, which is much healthier. Right now, though, what we see is many yields are still below the inflation rate, so you have real negative rates still in effect. But as inflation comes down, that is likely, to move towards a more normalized position. We keep sticking to shorter durations. The short end of the curve is signaling the Fed is going to move for longer. The intermediate to longer positions on the yield curve are suggesting that the Fed is going to be successful based on the yields we're seeing, where the 10-year Treasury is off its highs. We would have to say that what this says is you're going to get some success here. And that points to things are working. The main point, I certainly agree with your other guest, is what we are seeing here is action is being taken against inflation with commitment. And not brutal at that. It's just adequate so far.
John, I see that you have a nominal exposure to gold. Jenny, some of your best ideas include exposure to other metals, namely aluminum.
Right. So that one of the company that you're referring to, Contessa, is Ardagh, and they make aluminum cans. That's actually not a play on aluminum. It's a play on aluminum can making, and it's also a play on stocks that have been completely thrown out. So this is an aluminum can maker. They have a 9% dividend yield. It came public a year and change ago in a SPAC structure. Everybody hates SPACs and turned on them. So this stock, because it was associated with that, got completely thrown out and treated as if it was worth nothing.
And you also like Uber
but,
and Palo.
Probably each one of us.
Uber and Palo Alto.
Yeah. Right, not metals plays.
Yeah.
The reason I gave you that list was I was thinking, okay, this is a really tough environment, and we're still waiting to see how things flesh out. So where are places that you can invest right now where there's certainty of cash flows, certainty of return, a lot of clarity? And so Uber, for example, Uber turns enormously free cash flow positive next year. Palo Alto has a 6% free cash flow yield. These two aren't dividend stocks. They're in our growth strategy.